This deep dive is prepared by QIP Capital Academy. Welcome to the deep dive.
Glad to be here.
Today, we're really plunging into a key economic idea using the sources you sent us, M2 money supply.
Right, M2.
Our goal really is to cut through some of the noise, figure out what M2 actually is, why it matters, what makes it change, and what it might tell us, especially about the financial markets.
Okay.
All right, let's get into it. Looking at these materials, M2 seems, pretty central to understanding how money moves. What's the basic idea?
Yeah, what's really interesting, I think, is how M2 gives us this concrete way to measure just the sheer amount of money available in the economy. It's not just the cash in your wallet. It's way broader. It's about the total potential, purchasing power out there.
Okay, and the sources, they break down what counts as M2. It's not just M1, is it? There's more to it.
That's exactly right. So M2 includes M1, that's the most liquid stuff. Think physical cash, the money in your checking account you can grab instantly.
Right, debit card, check.
But then M2 layers on top of that. It adds assets that are still pretty easy to access, but maybe like one step removed.
Like savings accounts.
Exactly. Savings accounts, smaller CDs, those time deposits usually under $100,000, and retail money market funds. Your source has really highlighted this broader picture. It's this M2 number that, economists and investors tend to watch really closely.
So why this number then? Why M2 specifically? The materials really stressed how important it is.
Yeah, it's a good question. Why track this one? The sources point out that M2 growth is often seen as a kind of leading indicator for what the economy might do next. If M2 is growing, it suggests there's more money kind of sloshing around available to be spent or invested.
Okay.
And that usually lines up with a more active economy, potentially growth. But the flip side is if M2 growth slows down or even shrinks, it suggests money is tightening up. And that can come before people spending less, maybe a slower economy overall.
Right, okay. Now, here's where the sources got really interesting for me. What actually makes M2 go up or down? It can't just be people deciding to save more one month, can it? It feels bigger.
Oh, definitely not just that. I mean, consumer behavior plays a role, sure, but the really big drivers, they're much larger forces. Central bank policy is absolutely key.
Like interest rates.
Exactly. Interest rate decisions, things like quantitative easing. When the central bank makes it cheaper to borrow, banks tend to lend more. And here's the crucial part. Bank lending itself actually creates new money in the system.
Okay.
Which directly boosts M2. And then you have government actions, big spending programs, tax changes. Those also inject or remove money from the economy, affecting M2. The sources really hammered home that link between policy and the money supply.
And that link, more money, more spending, it sounds like it leads straight to inflation, which is a major theme in the materials.
It absolutely does. If M2 grows really fast
and
the economy can't keep up producing enough goods and services, well, you get that classic too much money chasing too few goods.
Inflation.
Right, that's inflationary pressure. The sources detailed how a big surge in M2 can really fuel price hikes. But then again, if M2 contracts too sharply, yes, it can help cool inflation, but it also carries the risk of choking off economic activity, maybe even tipping into recession. So central banks, they're constantly watching M2, trying to find that sweet spot.
So what about markets? Stocks, bonds, crypto? How does M2 affect all that, according to the sources?
Connecting it all. M2 has a pretty significant impact there. Your materials show that when M2 is rising, money's generally abundant, often cheaper because rates are low.
Right.
Investors tend to feel more confident, they have more capital, and often that money flows into riskier asset stocks, maybe cryptocurrencies potentially pushing prices up.
And when M2 tightens?
Then you often see the reverse. Money tends to pull back from those riskier assets. Bond markets feel it too, reacting to M2 changes and what that implies about future interest rates.
The sources gave that really clear recent example, the whole COVID-19 period.
Yes. That was a perfect illustration highlighted right there in the materials. During the pandemic, you had this huge combination of government stimulus plus rock-bottom interest rates. And that led to just an unprecedented surge in M2. One article you shared mentioned growth hitting almost 27% year over year at one point.
Wow, 27% up.
Astonishing. Just flooding the system with liquidity. But then as inflation really took off, the Fed started hiking rates aggressively in 2022. And M2 growth just slammed on the brakes. It slowed dramatically, even went negative later that year. That was a clear signal they were pulling liquidity out to cool things down.
So pulling it all together from the sources, M2 isn't just some obscure number. It's like a vital sign reflecting the amount of financial firepower ready to go in the economy.
Yeah.
A simple but, well, pretty powerful tool for trying to read the economic tea leaves, inflation risks, potential slowdowns, influencing big decisions.
Absolutely. What's fascinating is how M2 sort of cuts through the complexity and just shows you, at a high level, how much actual liquidity, how much potential spending power is really out there.
Okay, so our final provocative thought for you, based on this deep dive. Given these direct links the sources showed between central bank moves, government policy, and how M2 behaves, how might paying closer attention to this number, maybe anticipating its shifts, give you an edge in understanding where markets might be heading before it happens?